What does it mean when the richest people on Earth start selling their own success stories? Between February and November of 2024, the world's wealthiest individuals executed one of the most coordinated financial exits in modern history, selling over $50 billion of their personal stock in the companies they built. This wasn't a trickle, it was a flood. Jeff Bezos sold $13 billion in Amazon. Mark Zuckerberg unloaded over $9 billion in Meta. Larry Ellison cashed out billions from Oracle. And, perhaps most tellingly, Jamie Dimon, the unshakable captain of JP Chase, sold stock for the first time in his entire 18-year tenure as CEO. The public explanations are always ready. Tax planning, estate planning, funding, philanthropy. But you don't need to move to Florida to save on taxes after you've been a billionaire for 25 years. You don't suddenly need to do estate planning at age 68 when you could have done it any time in the last 2 decades. These are not ordinary investors making ordinary moves. These are the architects of trillion-dollar empires, individuals who have weathered the dot-com bust, the 2008 crisis, and a global pandemic, holding firm through it all. They don't operate on emotion. They operate on a level of data and foresight the public can't access. And right now, that data is telling them to get out. This video will expose the scale of this billionaire exodus. We will decode the 5 historical patterns that prove this kind of insider selling has predicted every major market crash with chilling accuracy. We will explore what these billionaires might be seeing in their proprietary data that signals danger ahead. And, crucially, we'll discuss what this means for the broader economy and for your own financial future. This isn't about fear-mongering. It's about pattern recognition. And the pattern suggests we are navigating the most precarious economic setup in a generation. Let's start by pulling back the curtain on what insider selling really means and why it's the most potent signal in finance. Insiders are not day traders. They are corporate executives, board members, and major shareholders who live and breathe the inner workings of their companies. They see real-time sales dashboards, internal forecasts, competitive threats, and margin pressures months before anything hits a quarterly earnings report. Jeff Bezos doesn't just read about Amazon's performance, he sees the minute-by-minute pulse of every division. Jamie Dimon has a god's-eye view of the American economy through JP Morgan's loan books, watching default rates and commercial real estate delinquencies tick up in real time. When these individuals buy stock with their own money, it's a powerful vote of confidence. When they sell, especially at scale, it's a statement. The data is tracked by firms like the Washington Service, which calculates an insider sell-buy ratio. A normal, healthy ratio is around 2-to-1 or 3-to-1 insiders routinely sell a few shares for diversification. But when that ratio spikes, history pays attention. In 2024, the ratio hit a staggering 9-to-1 for the full year, meaning insiders were selling $9 of stock for every $1 they bought. In some months, it spiked to 12-to-1. This is the most extreme imbalance since 2007. We all remember what happened in 2008. Now let's look at the specific, breathtaking sales that define this exodus. This isn't about one person. It's about a chorus of the world's most successful business minds singing the same tune. Jeff Bezos and Amazon, the $13 billion signal. In early 2024, Bezos announced a plan to sell 50 million Amazon shares, executing sales that netted over $8 billion. Then, in a move that speaks to a long-term strategy rather than a one-off event, he adopted another plan in March 2024 to sell up to 25 million more shares by January 2025. He has continued this methodical selling into 2025. The total from 2024 alone exceeded $13 billion. Context is critical. Bezos held Amazon stock for 30 years through every boom and bust. His previous record sale was around $10 billion in 2020, spread over a full year to fund his space company, Blue Origin, and occurring when stock prices were lower. The 2024 to 2025 sales are different, concentrated, rapid, and occurring as Amazon's valuation soared past $2 trillion. The stated reason a move to tax-free Florida rings hollow for a man who could have made that move any time in the last quarter century. This isn't tax optimization. It's capital preservation at a generational peak. Mark Zuckerberg and Meta cashing out at the AI summit. Throughout 2024, Zuckerberg executed a steady drumbeat of sales under pre-arranged trading plans, selling over $940 million in Meta stock. This occurred as Meta's stock price tripled from its 2022 lows, fueled by AI hype and cost-cutting, pushing the company's market cap past $1.3 trillion. Zuckerberg controls Meta through supervoting shares, meaning he never has to sell for influence. He could fund his philanthropy by borrowing against his shares at low interest rates, a common billionaire tactic. Instead, he's converting paper wealth into cash at the market's peak. That's not charity planning. It's a deliberate liquidation. Jamie Dimon and JP Chase, the most ominous bellwether. If one sale should give every investor pause, it's this one. Jamie Dimon, the veteran CEO who steered JP Morgan through the 2008 crisis, had never sold a single share of his company's stock, granted as compensation, in his 18-year tenure. He preached long-term alignment. In 2024, he sold 1 million shares. The reason cited was estate planning. Dimon is 68. He could have done estate planning in 2010, 2015, or 2020. He chose the moment when, as the head of America's largest bank with $3.9 trillion in assets, he has a front-row seat to the unfolding stresses in the economy. Loan defaults, consumer credit cracks, and the silent crisis in commercial real estate. For the man with the best economic dashboard on the planet to sell for the first time ever, it's not a family financial move. It's a 5-alarm fire. The pattern is universal. The list goes on, and it's damning in its consensus. Larry Ellison, Oracle's co-founder, sold hundreds of millions. NVIDIA's CEO Jensen Huang sold nearly $600 million, as his company briefly became the world's most valuable on AI fervor. The Walton family, stewards of the Walmart legacy for over 60 years, sold billions. Michael Dell scored his biggest payday ever and then began selling Dell stock. Across the board, tech billionaires alone sold over $15 billion in shares in the first 9 months of 2024. These are not weak hands. These are the ultimate strong hands, builders who held for decades through every storm. Their collective decision to become sellers now is a unanimous, deafening vote that 2024 to 2025 represents a historic valuation peak. The total figure is staggering. Aggregate insider selling in 2024 reached approximately $464 billion. Let that sink in. The only year in history that saw more insider selling was 2007, with $650 billion. We know what followed in 2008, the worst financial crisis since the Great Depression, which wiped out $16 trillion in wealth. The parallel is not a coincidence, it is a precedent. This brings us to the core of the issue: history. This isn't the first time insiders have fled before a storm. In fact, it's a playbook with a perfect, terrifying record. Let's break down the 5 historical patterns that transform these sales from interesting anecdotes into a dire forecast. Pattern 1. Insiders sell 1, 2 to 4. Months before major market peaks, they see the cracks forming in the foundation while the public is still admiring the penthouse view. In 1987, insider selling spiked 350% in the first half of the year. The market peaked in August and crashed in October. In 2000, record selling in late 1999 and Q1 2000 preceded the Nasdaq's March peak and its subsequent 78% collapse. In 2007, the $650 billion insider selling year directly preceded the October peak and the 57% crash in the S&P 500. The mechanism is simple. Insiders exit at 90 to 100% of peak prices. The market, fueled by retail euphoria and institutional momentum, can grind higher for months. Then it collapses. The insiders, safe in cash, watch and wait to buy back at a steep discount. This is the brutal mechanics of wealth transfer. Pattern 2, the sell-buy ratio spikes above 8 to 1. This is the quantitative proof, every single time since 1975, that the Washington Services sell-buy ratio has sustained a reading above 8 to 1. A major market crash has followed within 24 months. In 1987, it hit 9 to 1 before the October crash. In 2000, it hit 11 to 1 before the dot-com burst. In 2007, it hit 8 to 1, spiking to 10 to 1. In 2024, the full-year ratio hit 9 to 1, with quarterly spikes to 12 to 1. The pattern is 8 for 8. There are 0 false signals in nearly 50 years of data. The alarm is not just ringing, it's screaming. Pattern 3, sector-specific canaries. Insiders in the most overvalued sectors sell first, providing a roadmap to the epicenter of the coming quake. In 2000, it was tech insiders fleeing while analysts issued $500 price targets for profitless companies. In 2007, it was financial insiders, the CEOs of Lehman Brothers and Bear Stearns, cashing out while touting their firm's strength. In 2024, who is selling tech and financials? Again, the very sectors riding the AI bubble and sitting on potential commercial real estate losses are seeing their own architects head for the exits. They are telling you exactly where the danger is most concentrated. Pattern 4. When the forever holders sell, the top is in. This is the qualitative clincher. Jeff Bezos, 30-year holder, Jamie Dimon, 18-year holder, Larry Ellison, 47-year holder, the Walton family, 62-year holders. These are not traders. They are founders and stewards whose identities are intertwined with their companies. Their transition from eternal holders to motivated sellers is a psychological market top. It means they believe current valuations represent as good as it gets for the foreseeable future. Pattern 5. No new highs for years. This is the killer statistic for anyone hoping for a quick rebound. Since 1975, every time annual insider selling exceeded $400 billion adjusted for market size, the market did not make new highs for years. After the 2000 peak, it took 7 years to see new highs. After 2007, it took 6 years, with 2024 at $464 billion. History suggests the S&P 500 will not reclaim its 2024 to 2025 peak until 2030 or later. This implies not a brief correction, but a prolonged bear market or a deep scarring crash. The natural question is, what do they know? What are these billionaires seeing in their crystal balls that justifies this unprecedented retreat? While their proprietary internal data is secret, we can infer the macro and micro pressures from public information and expert analysis. First, they see bubble-level valuations across the board. Warren Buffett's favorite metric, total market cap to GDP, the Buffett indicator, is flashing red. It currently sits near 185%, meaning the stock market is valued at nearly double the annual output of the entire U.S. economy. The only times it has been higher were brief spikes before major crashes. The Shiller P/E CAPE ratio, which smooths out earnings cycles, is at 34. It has only been higher 3 times, 1929, 2000, and briefly, in 2020, every instance preceded a devastating crash. These billionaires are students of history. They know these numbers are unsustainable. Second, they see a powder keg of leverage in the system. Margin debt money borrowed to buy stocks hovered near a record $950 billion in late 2024. This is dangerous because leverage amplifies gains on the way up, but creates a cascade of forced selling on the way down. When prices fall, brokers issue margin calls, forcing investors to sell stocks to cover their loans. This selling pushes prices down further, triggering more margin calls. In 2008, this feedback loop turned a downturn into a meltdown. The smart money exits before this cascade begins, knowing they can't stop it once it starts. Third, they see specific ticking time bombs within the economy. Commercial real estate is a $1 trillion plus problem. With office buildings facing 40 to 50% vacancy rates and loans maturing at much higher interest rates, a corporate debt refinancing crisis looms, with trillions in cheap debt borrowed at 2 to 3%, needing to be rolled over at 6 to 8%, a burden many companies cannot bear. These aren't abstract concepts to Jamie Dimon. They are loan files on his desk. Furthermore, the sheer scale of U.S. federal debt and deficits creates a backdrop of profound monetary instability, encouraging a flight from financial assets to tangible stores of value. Fourth, and most importantly, they see their own company's internal data softening. This is the secret sauce. Bezos isn't just seeing Amazon's public earnings, he's seeing the daily internal metrics, perhaps slowing growth in AWS cloud services, margin compression in e-commerce, or softening advertising demand. Zuckerberg sees Meta's real user engagement trends and the astronomical, possibly unsustainable, costs of the AI arms race. Their sales suggest that future public earnings may not justify today's soaring stock prices. They are selling on tomorrow's news. Today, the convergence of these factors creates a terrifying risk-reward calculation. For a billionaire like Bezos, The potential upside of holding might be another 10 to 20% if the bubble inflates further. The potential downside in a crash is 50 to 60%. When you're managing hundreds of billions, that's an indefensible gamble. The rational move is to sell, preserve capital, and hold the dry powder to buy quality assets at fire sale prices later. This isn't pessimism, it's supreme financial rationality. So, what is the timeline? History provides a grim framework. The average lag between peak insider selling and a market crash is 12 to 18 months. The heaviest selling in 2024 occurred in Q2 and Q3. If the pattern holds, the danger window is Q2 2025 through Q2 2026. This aligns with other converging factors: the peak of commercial real estate, loan maturities, the crescendo of corporate debt refinancing, and the volatile period following a U.S. presidential election. The trigger could be anything: a major bank failure, a corporate default cascade, or a geopolitical shock. But in a fragile, over-leveraged system, the trigger is almost irrelevant. The conditions for a crash are preloaded. The aftermath will create clear winners and losers, a story of wealth preservation versus wealth destruction. The winners are those who mimic the billionaires' current playbook. The insiders themselves will be winners. By selling high, they position themselves to buy back vast stakes at depressed prices, emerging from the crisis with greater ownership and wealth. Those holding significant cash will win, as cash becomes king during a panic. Enabling the purchase of assets at generational lows, holders of gold, the classic crisis hedge, are also positioning to win. Gold has surged over 60% in the past year, trading above $4,200 per ounce, as investors seek safety from market turmoil and potential currency debasement. Even major Wall Street players, like Jeff Yass of Susquehanna International Group, have been massively increasing their bets on gold. The losers, tragically, will be the unprepared middle class and institutional investors. Middle-class wealth is predominantly in three baskets: 401k retirement accounts, heavily weighted to stocks, home equity, and savings. A 50% market crash could have the retirement savings of someone on the verge of retiring, destroying decades of responsible planning. Pension funds like CalPERS, which manage hundreds of billions for public employees, would face catastrophic losses, potentially leading to benefit cuts. Leveraged investors, anyone who bought stocks on margin, will be wiped out completely. This is the brutal reality of the wealth transfer that crashes facilitate, from the many to the few, from the reactive to the proactive. Given this, what can you do? You can't control the market, but you can control your positioning. The goal is not to panic, but to prepare rationally. First, reduce equity exposure and raise cash. If your portfolio is 80% stocks, consider reducing to 50 to 60%. Yes, you might miss the final frothy gains of a bull market, but you will preserve capital for the buying opportunity of a lifetime. The billionaires are raising cash. You should consider it your most valuable asset for the next 12 to 18 months. Second, consider a strategic allocation to gold. It's not a get-rich-quick scheme, but insurance. A 5 to 10% allocation to physical gold or a reputable ETF can act as a buffer against systemic financial stress and currency devaluation. Its recent performance speaks to its role as a safe haven. Third, prepare a buy list now. When fear is rampant and quality companies are trading at 40 to 50% discounts, you need to know what you want to own. Identify companies with fortress balance sheets, essential products, and durable competitive advantages. Do your research while markets are calm, so you can act decisively when they are chaotic. Fourth, do not attempt to short the market unless you are a seasoned professional. The billionaires aren't shorting, they're simply selling and moving to safety. Shorting requires perfect timing and carries unlimited risk. As the saying goes, the market can stay irrational longer than you can stay solvent. Fifth, fortify your personal finances. Build an emergency fund of 6 to 12 months of expenses. In a recession with rising unemployment, job security cannot be taken for granted. Having a cash runway prevents you from being forced to sell investments at the worst possible time. Finally, prepare psychologically. A crash will be a media frenzy of panic. Your portfolio statement will be painful to read. Friends will be selling in fear. Your gut will tell you to join them. You must have the conviction to do the opposite, to be a calm buyer when there's blood in the streets. That mental preparation starts today. The billionaire exodus of 2024 is a fact, not a theory. Over $50 billion in personal sales from the world's most informed investors, a sell-buy ratio at its most extreme since the year before the great financial crisis. The historical patterns are not just suggestive, they are prescriptive. We are in the 12 to 18-month window that has preceded every major market crash in modern history. The insiders are not wrong, they are early, and they are never wrong together, on this scale, by accident. This is not a call to predict the day or the hour. It is a call to recognize the season. The smartest minds in business are battening down the hatches. The question is, will you? The coming period will separate those who are swept away by the storm from those who build their fortunes in its aftermath. The choice is yours.